In November 2022, one of the largest cryptocurrency exchanges in the world collapsed in less than a week. The platform was called FTX. At its peak, the exchange had been valued at $32 billion. Millions of customers used it to trade digital assets. Major venture capital firms invested billions into the company. Celebrities promoted the platform in advertising campaigns. Politicians met with its founder during policy discussions. Many investors believed FTX was one of the safest institutions in the crypto industry. The company presented itself as a responsible bridge between crypto markets and traditional finance. Behind the reputation, however, a structural weakness existed. Customer deposits were not fully separated from internal trading operations. Funds were quietly redirected to an affiliated trading firm called Alameda Research. Losses accumulated inside that trading operation. To maintain the appearance of stability, internal accounting assumptions filled the gap. For a period, the structure appeared sustainable. The exchange continued processing trades and attracting new deposits. But the system depended entirely on customer confidence. In early November 2022, that confidence began to break. Customers rushed to withdraw billions of dollars from the exchange. Within days, the liquidity illusion collapsed. FTX revealed how quickly financial trust can evaporate in digital markets. FTX was founded in 2019 by Sam Bankman-Fried. Before launching the exchange, Bankman-Fried operated a cryptocurrency trading firm called Alameda Research. Alameda specialized in arbitrage strategies across global crypto markets. These strategies attempted to profit from price differences between exchanges. Through this activity, the firm accumulated significant trading capital. Bankman-Fried believed existing crypto exchanges lacked advanced trading tools. Many platforms were designed primarily for retail traders. Professional investors often struggled to manage risk on those exchanges. FTX was designed to address that gap. The platform focused on cryptocurrency derivatives and complex trading products. Users could trade futures contracts tied to digital assets. These instruments allowed traders to speculate on price movements without owning the underlying tokens. The exchange launched during a period of increasing interest in crypto markets. Bitcoin prices had begun recovering after earlier market declines. Retail trading activity was expanding rapidly across digital platforms. FTX marketed itself as a technologically sophisticated exchange. The platform offered leveraged trading and advanced order systems. Professional traders quickly adopted the exchange. Liquidity on the platform expanded as more traders joined. At the same time, venture capital firms began investing in the company. Several prominent investment funds participated in funding rounds. These investments provided capital for global expansion. The exchange opened offices in multiple jurisdictions. FTX also acquired smaller companies to expand its services. Marketing campaigns increased the company's visibility. The exchange purchased naming rights to sports arenas. Major sponsorship deals connected the brand with professional sports teams. Celebrity endorsements reinforced the platform's reputation. Television advertisements promoted the exchange as accessible and reliable. Institutional investors interpreted these signals as evidence of credibility. The company's valuation increased rapidly across funding rounds. By 2021, investors valued FTX at approximately $32 billion. The exchange processed billions of dollars in daily trading volume. Industry rankings placed FTX among the largest cryptocurrency exchanges in the world. Sam Bankman-Fried became a highly visible figure in financial media. He participated in conferences discussing cryptocurrency regulation. Policy discussions increasingly included representatives from the company. FTX presented itself as a responsible actor within the crypto industry. The exchange promoted risk management and regulatory cooperation. Investors interpreted this messaging as a sign of institutional maturity. Rapid growth reinforced the company's credibility. Few observers examined how the exchange managed customer deposits internally. The success of the platform appeared aligned with broader crypto market expansion. During bull markets, financial structures often face limited scrutiny. Bull markets conceal structural risk. Between 2020 and 2021, cryptocurrency markets expanded at an extraordinary pace. Bitcoin prices rose dramatically during this period. In early 2020, Bitcoin traded below $10,000. By late 2021, the price briefly exceeded $60,000. This surge attracted millions of new participants to crypto markets. Retail investors began opening accounts on digital exchanges worldwide. Many individuals viewed cryptocurrencies as a new investment frontier. At the same time, global economic conditions supported speculative activity. Central banks maintained historically low interest rates. Governments introduced large stimulus programs during the pandemic. Financial markets therefore contained abundant liquidity. Investors searched for higher returns across emerging sectors. Cryptocurrency markets became one of the primary destinations for this capital. Trading volumes expanded across major exchanges. Crypto derivatives markets also grew rapidly. These derivatives allowed traders to take leveraged positions on price movements. Leverage increased both potential gains and potential losses. Platforms offering sophisticated trading tools attracted professional investors. FTX positioned itself within this environment. The exchange promoted advanced risk management systems. It also emphasized fast trading infrastructure and deep liquidity pools. Professional traders valued these capabilities. Institutional investors began exploring cryptocurrency exposure. Some hedge funds opened accounts on crypto exchanges. Venture capital firms invested heavily in blockchain-related companies. This institutional participation reinforced confidence in the industry. Financial media frequently reported the growth of digital asset markets. Crypto companies began sponsoring major public events. Advertising campaigns appeared during high-profile sporting broadcasts. Public awareness of cryptocurrency increased rapidly. Many investors interpreted rising prices as evidence of technological transformation. However, rapid growth often masks underlying fragility. Market expansion was supported by speculative capital flows. Many participants relied on borrowed funds to increase exposure. The widespread availability of leverage amplified market volatility. Crypto exchanges competed to attract traders with increasingly complex products. The speed of innovation often outpaced regulatory oversight. As long as prices continued rising, structural weaknesses remained hidden. Market optimism discouraged careful examination of business models. Confidence became a substitute for transparency. During periods of abundant liquidity, financial discipline often weakens. When capital is easily available, risk tolerance expands. Easy money accelerates fragile models. As FTX expanded its trading platform, the company introduced an internal digital asset known as FTT. FTT functioned as the exchange's native utility token. The token provided discounts on trading fees for platform users. It also granted certain benefits within the FTX ecosystem. Exchange tokens had become a common feature among cryptocurrency platforms. These tokens were often marketed as a way to align users with the success of the exchange. In theory, if the exchange grew, demand for the token would increase. FTX adopted this model during its early expansion. The company issued a fixed supply of FTT tokens. A portion of the tokens was sold to investors through private and public offerings. Another portion remained controlled by entities associated with the exchange. As trading activity increased, FTX promoted the token as a core component of its platform. Demand for FTT therefore depended heavily on the reputation and growth of the exchange. Rising platform activity supported rising token prices. This dynamic created a feedback loop between exchange growth and token valuation. As FTT increased in price, it appeared to strengthen the financial position of the ecosystem. The token also became useful as collateral within crypto markets. Some traders used FTT to secure borrowing or leveraged trading positions. Entities associated with FTX also held large quantities of the token. These holdings could be recorded on balance sheets as valuable assets. However, the token's value ultimately depended on confidence in the exchange itself. Unlike traditional assets, the token was created internally by the platform. This meant the exchange could influence both supply and market perception. In practice, the token's liquidity remained limited. Large holders, therefore, faced difficulties selling significant quantities without affecting the price. Despite this limitation, the token appeared valuable on paper. Balance sheets referencing the token showed large asset values. These valuations contributed to the overall financial narrative surrounding the company. The more the exchange grew, the more credible the token appeared. At the same time, the token supported the exchange's broader valuation. Venture capital investors often used token metrics as part of their investment analysis. Because FTX controlled significant portions of the token supply, price stability reinforced the company's balance sheet. However, the structure depended on continued market confidence. If confidence weakened, the token's price could decline rapidly. Because the asset was internally issued, its value lacked independent verification. This created a circular financial structure. The exchange supported the token's credibility. The token supported the exchange's balance sheet. Each depended on the stability of the other. When internal assets support external valuations, financial systems become fragile. Self-issued assets create circular value. Alongside the FTX exchange operated a trading firm called Alameda Research. Alameda had been founded earlier by Sam Bankman-Fried in 2017. The firm specialized in quantitative cryptocurrency trading strategies. Its operations included arbitrage, market making, and speculative trading. In theory, Alameda and FTX were separate companies. One operated as a trading firm, the other operated as a cryptocurrency exchange. Public communications often describe the two organizations as independent. However, the relationship between them was unusually close. Sam Bankman-Fried had leadership influence over both entities. Several senior executives also worked across the two organizations. The companies shared infrastructure and internal communication channels. This arrangement created overlapping operational control. At the same time, Alameda maintained accounts on the FTX exchange. As a trading firm, it could borrow funds and take leveraged positions. Normally, exchanges require strict collateral when customers borrow funds. Collateral protects the exchange if trading positions lose value. Evidence later suggested Alameda received special privileges. The firm reportedly had larger borrowing limits than other users. Some internal controls that applied to normal customers were adjusted. This arrangement allowed Alameda to maintain very large trading positions. Those positions exposed the firm to significant market risk. At the same time, Alameda held large quantities of the FTT token. These holdings were recorded as valuable assets on internal balance sheets. Because FTT depended on the reputation of FTX, the two entities became financially linked. Losses inside Alameda could therefore influence the stability of the exchange. Another critical element involved customer deposits. Crypto exchanges typically hold customer funds in custody. Those funds are expected to remain available for withdrawal. Investigations later suggested that large amounts of customer money moved from FTX to Alameda. These transfers reportedly supported Alameda's trading activities. If trading positions performed well, the system appeared stable. But if trading losses occurred, the deposits supporting those positions became vulnerable. Because the two entities were closely connected, the risks were concentrated in a single structure. public disclosures did not fully explain the scale of this exposure. Externally, the exchange continued operating normally. Customers traded and deposited funds without noticing the internal relationship. Confidence in the platform remained high throughout this period. However, the separation between the exchange and the trading firm existed largely on paper. When institutions share leadership, capital, and risk, boundaries become difficult to maintain. Separation on paper is not separation in reality. During 2021 and early 2022, FTX continued expanding its operations across global markets. Millions of users deposited digital assets onto the platform. These deposits were intended to support trading activity on the exchange. Customers expected that their funds could be withdrawn at any time. In principle, cryptocurrency exchanges function as custodians of user assets. The platform holds funds while customers execute trades. Those funds must remain available to satisfy withdrawal requests. However, the internal structure at FTX created a different dynamic. Large portions of customer deposits were reportedly transferred to Alameda Research. These transfers supported Alameda's trading operations and investment activities. Some of those investments involved illiquid venture capital projects. Others involved leveraged trading positions across crypto markets. Illiquid assets cannot be quickly converted into cash during periods of stress. This created a mismatch between available liquidity and customer obligations. Customers expected immediate access to their deposits, yet the underlying assets supporting those deposits were not always liquid. As long as trading conditions remained stable, this mismatch was not visible. Withdrawals occurred gradually under normal market conditions. The exchange, therefore, appeared fully functional. The system relied on the assumption that only a small percentage of customers would withdraw funds at once. This assumption is common in many financial institutions. Banks, for example, also rely on deposit stability. However, banks operate under regulatory supervision and deposit insurance systems. Crypto exchanges typically lacked comparable safeguards. Without such protections, confidence becomes the primary stabilizing force. FTX continued attracting deposits and new users during this period. The platform processed billions of dollars in daily transactions. Public confidence remained strong across the crypto industry. Yet the internal liquidity position was becoming increasingly fragile. If market conditions triggered large withdrawals, the exchange would need immediate liquidity. Illiquid investments would not be able to cover sudden outflows. At the same time, Alameda's trading exposure increased financial pressure. Losses in leveraged trading positions could further reduce available capital. The structure therefore depended heavily on continued trust from users. As long as customers believed the platform was solvent, deposits remained stable. But financial systems built on confidence can reverse quickly. When withdrawal demand rises suddenly, liquidity assumptions are tested. The stability of the exchange therefore depended on behavior it could not control. Customers ultimately determine when liquidity becomes necessary. Liquidity exists only until withdrawals begin. In early November 2022, a report began circulating within the cryptocurrency industry. The report described elements of Alameda Research's balance sheet. It was published by the financial news outlet CoinDesk on November 2, 2022. According to the report, a large portion of Alameda's assets consisted of the FTT token. FTT was the internal token issued by the FTX exchange. The report suggested that Alameda held billions of dollars worth of this token. Because the token was closely linked to FTX, the balance sheet appeared highly concentrated. Market observers began questioning the reliability of those asset valuations. If the token's price declined significantly, Alameda's financial position could weaken quickly. This raised concerns about the broader relationship between Alameda and FTX. Investors began examining whether Alameda's assets depended heavily on the exchange's internal token. The report circulated rapidly across cryptocurrency trading communities. Discussion intensified on social media platforms and financial forums. Traders started reconsidering the financial stability of the companies involved. Confidence in FTX began to show signs of weakening. Another major event occurred shortly after the report. Changpeng Zhao, the chief executive of Binance, announced a decision regarding FTT holdings. Binance had previously invested in FTX and held a large quantity of the token. On November 6, 2022, Zhao stated that Binance intended to sell its FTT position. The announcement was made publicly through social media. Markets interpreted the message as a signal of declining confidence. The price of FTT began falling quickly. As the token declined, concerns about Alameda's balance sheet intensified. Traders questioned whether the firm could maintain its financial obligations. At the same time, attention shifted toward FTX's relationship with Alameda. Customers began asking whether the exchange held sufficient liquidity. The market reaction spread rapidly through the crypto ecosystem. Prices of related assets experienced volatility. Trading volumes increased across multiple exchanges. Within hours, market confidence was shifting. Financial stability in digital markets depends heavily on perception. When confidence begins to weaken, reactions can occur extremely quickly. Rumors and speculation intensified on online trading communities. Market participants began preparing for potential instability. Some customers initiated withdrawals from the exchange. These early withdrawals were relatively small compared to total deposits. However, they represented the first signs of declining trust. In financial systems built on confidence, perception can become reality. Confidence turns faster than capital. Following the balance sheet revelations in early November 2022, customer behavior began changing rapidly. Users of the FTX exchange started withdrawing their funds. Initial withdrawals were modest compared to the total deposits on the platform. However, the volume increased quickly as concerns spread across the market. Social media discussions amplified speculation about the exchange's liquidity. Crypto traders closely monitor the stability of trading platforms. Even small doubts can trigger defensive actions. Customers prefer to secure their funds before a potential disruption occurs. Within a short period, billions of dollars in withdrawal requests were submitted. This surge created immediate pressure on the exchange's liquidity. Exchanges must maintain sufficient liquid assets to process withdrawals. If deposits have been redirected into other investments, available liquidity may decline. Evidence later suggested that FTX did not hold enough liquid reserves. Customer deposits had reportedly been used to support Alameda Research trading activities. As withdrawal requests accelerated, the exchange struggled to fulfill them. Processing delays began appearing on the platform. Some customers reported waiting extended periods for withdrawals to complete. Market observers interpreted these delays as warning signs. Confidence continued deteriorating across the crypto ecosystem. Large investors and trading firms began withdrawing funds rapidly. Within days, the total withdrawal demand reached several billion dollars. This behavior resembled a classic financial bank run. Bank runs occur when depositors simultaneously request access to their funds. If institutions cannot provide immediate liquidity, the system becomes unstable. Unlike traditional banks, crypto exchanges do not have central bank support. They also lack deposit insurance mechanisms. Therefore, the stability of exchanges depends almost entirely on customer trust. Once that trust weakens, withdrawals accelerate. FTX attempted to stabilize the situation through external support. Negotiations began with Binance regarding a potential acquisition. Initially, Binance announced a non-binding agreement to evaluate the exchange. The announcement temporarily slowed market panic. However, after reviewing financial information, Binance withdrew from the deal. The withdrawal signaled deeper financial problems within FTX. Confidence in the exchange collapsed rapidly. Withdrawal requests continued increasing beyond the platform's capacity. Soon afterward, FTX halted customer withdrawals entirely. This decision confirmed that liquidity had been exhausted. Without the ability to process withdrawals, the exchange could no longer function normally. Crypto exchanges operate similarly to financial institutions holding customer deposits. However, they do not provide the safeguards typical of regulated banking systems. Crypto exchanges are banks without insurance. By November 2022, the financial position of FTX had deteriorated rapidly. Customer withdrawals had drained much of the platform's available liquidity. Efforts to secure emergency funding were unsuccessful. Potential investors reviewing the exchange's financial records raised serious concerns. The scale of the liabilities appeared larger than previously understood. Without new capital, the company could not continue operating normally. On November 11, 2022, FTX filed for Chapter 11 bankruptcy protection in the United States. The filing applied to FTX Trading Ltd. And numerous affiliated entities. At the same time, Sam Bankman-Fried resigned as chief executive officer. A restructuring specialist named John J. Ray III assumed control of the company. Ray had previously overseen the liquidation of Enron during the early 2000s. Shortly after taking control, the new leadership began reviewing internal records. Initial findings revealed serious weaknesses in financial oversight. Corporate governance systems appeared minimal or absent in several areas. Internal accounting documentation was incomplete. Many financial decisions had reportedly been communicated through informal messaging platforms. The company lacked clear records of customer asset custody. Investigators also discovered large transfers between FTX and Alameda Research. These transfers involved billions of dollars in customer deposits. The new management described the corporate structure as highly disorganized. Several affiliated entities lacked proper accounting controls. Bank accounts were reportedly maintained across multiple jurisdictions. Some funds appeared difficult to trace immediately. Customers attempting to withdraw assets remained unable to access their accounts. The bankruptcy filing therefore confirmed the scale of the collapse. Financial markets reacted quickly to the announcement. Cryptocurrency prices declined sharply across multiple exchanges. Many investors realized that deposits held on the platform might not be fully recoverable. The bankruptcy process began assessing the remaining assets of the company. Legal teams started examining the obligations owed to customers and creditors. The situation revealed that a major financial institution had been operating with limited oversight. For years, the exchange had appeared stable and highly valuable, yet the internal financial structure proved fragile under stress. Large organizations can grow quickly during favorable market conditions. However, size does not necessarily reflect financial resilience. Institutions handling billions in customer assets require strict custody controls. Without such controls, operational complexity can conceal major risks. The FTX collapse demonstrated how quickly a digital financial institution can fail. Confidence had supported the platform during its expansion. Once confidence disappeared, the exchange could no longer function. Scale does not guarantee solvency. After the bankruptcy filing, legal investigations began almost immediately. Authorities in multiple jurisdictions examined the collapse of FTX. Regulators focused on how customer funds had been managed. Attention also turned toward the leadership of the exchange. Sam Bankman-Fried remained in the Bahamas, where FTX had been headquartered. In December 2022, authorities in the Bahamas arrested Bankman-Fried. The arrest occurred at the request of United States prosecutors. Shortly afterward, extradition proceedings began. Bankman-Fried was transferred to the United States to face criminal charges. Federal prosecutors charged him with multiple counts of fraud and conspiracy. The charges alleged misuse of billions of dollars in customer deposits. Investigators argued that those funds had been redirected to Alameda Research. According to the prosecution, these transfers supported risky trading activities. Some funds were also allegedly used for venture investments and political donations. The legal case attracted significant public attention. It became one of the most prominent financial fraud trials in the cryptocurrency industry. Several former executives from FTX and Alameda agreed to cooperate with investigators. Their testimony helped prosecutors reconstruct internal decision-making. Evidence presented in court described how funds moved between entities. Financial records and internal communications formed key parts of the trial. The proceedings examined the relationship between the exchange and Alameda. Prosecutors argued that customers had been misled about how their deposits were handled. Defense lawyers attempted to challenge these interpretations. They argued that business decisions occurred during a volatile market environment. However, prosecutors maintained that the core issue involved misuse of customer funds. The trial proceeded through 2023 in federal court. Witnesses included former employees and financial experts. Documents presented during the trial illustrated the internal financial structure. In November 2023, the jury reached a verdict. Sam Bankman-Fried was convicted on multiple counts of fraud and conspiracy. The verdict concluded one of the most closely watched financial trials of the year. The case reinforced the legal responsibility of executives managing customer assets. Financial institutions operate on the assumption of fiduciary duty. When those responsibilities are violated, legal accountability follows. The FTX collapse had already caused billions in losses across the crypto ecosystem. Many customers faced uncertainty regarding the recovery of their deposits. Court proceedings addressed criminal liability but could not reverse the damage. The legal outcome demonstrated that financial innovation does not eliminate legal obligations. Even in emerging markets, existing fraud laws still apply. The verdict marked an important moment for the cryptocurrency industry. Innovation does not exempt accountability. The collapse of FTX triggered widespread debate about the regulation of cryptocurrency markets. Policymakers around the world began examining the structure of crypto exchanges. Until that point, many exchanges had operated with limited regulatory oversight. Rules governing traditional financial institutions often did not apply to digital platforms. The scale of the FTX failure changed the tone of these discussions. Lawmakers questioned how an exchange handling billions in customer deposits had operated with minimal controls. Financial regulators began reviewing custody practices used by crypto platforms. Custody refers to how institutions store and safeguard customer assets. Traditional financial systems impose strict requirements on custodians. Banks and brokerages must separate client funds from operational capital. These safeguards are designed to prevent misuse of deposits. In the case of FTX, investigators alleged that this separation had not been maintained. The collapse therefore raised concerns about industry-wide practices. Some exchanges responded by publishing proof of reserves reports. These reports attempted to demonstrate that customer assets were fully backed. However, the reliability of such disclosures became a topic of debate. Proof of reserves snapshots do not necessarily reveal all liabilities. Regulators began exploring more comprehensive transparency requirements. Proposals included stricter auditing standards for crypto companies. Some policymakers advocated requiring exchanges to register as regulated financial institutions. Others focused on improving reporting obligations for digital asset platforms. International regulatory bodies also began coordinating responses. Because crypto exchanges operate globally, oversight often involves multiple jurisdictions. Regulatory reforms therefore require cooperation between national authorities. At the same time, industry participants debated the balance between innovation and oversight. Some argued that excessive regulation could slow technological development. Others emphasized the importance of protecting customer funds. The FTX collapse strengthened arguments for stronger safeguards. Investors became more cautious when selecting cryptocurrency exchanges. Institutional participants demanded greater transparency from trading platforms. Regulators continued reviewing proposals throughout 2023. Several countries introduced new frameworks for digital asset supervision. These frameworks attempted to address custody, disclosure, and risk management. The policy debate surrounding crypto markets remains ongoing. However, history shows that financial regulation often evolves after major failures. Large collapses reveal weaknesses that were previously overlooked. When those weaknesses become visible, policymakers respond. The FTX crisis therefore influenced the trajectory of global crypto regulation. Financial innovation can move faster than legal oversight, but when failures occur, regulatory systems adapt. Regulation follows collapse. The collapse of FTX quickly became one of the most studied failures in cryptocurrency history. Analysts examined the structure of the exchange to understand how the system had operated. Several recurring elements appeared throughout the investigation. One element involved the reuse of customer deposits. Exchanges are expected to hold client funds in custody. Those funds should remain available for withdrawal at all times. In the FTX structure, customer deposits were reportedly redirected into trading activities. These transfers exposed customer assets to market risk. Another structural feature involved internal leverage. The exchange issued a token called FTT. Large quantities of that token were held by entities connected to the platform. Because the token's value depended on the reputation of the exchange, its valuation was circular. Assets created internally supported the balance sheet externally. When confidence declined, the token's price fell rapidly. This reduced the perceived value. The collapse of FTX quickly became one of the most studied failures in cryptocurrency history. Analysts examined the structure of the exchange to understand how the system had operated. Several recurring elements appeared throughout the investigation. One element involved the reuse of customer deposits. Exchanges are expected to hold client funds in custody. Those funds should remain available for withdrawal at all times. In the FTX structure, customer deposits were reportedly redirected into trading activities. These transfers exposed customer assets to market risk. Another structural feature involved internal leverage. The exchange issued a token called FTT. Large quantities of that token were held by entities connected to the platform. Because the token's value depended on the reputation of the exchange, its valuation was circular. Assets created internally supported the balance sheet externally. When confidence declined, the token's price fell rapidly. This reduced the perceived value of assets backing the system. The FTX case illustrated how quickly confidence can reverse. Digital financial platforms operate at high speed. Information travels instantly across global markets. When concerns emerge, customers can withdraw funds within minutes. This speed accelerates both growth and collapse. Once trust begins to weaken, withdrawal pressure increases rapidly. Institutions without sufficient liquidity cannot withstand that pressure. The exchange therefore failed within a matter of days. The case revealed structural patterns that appear in many financial scandals. Opaque balance sheets, internal leverage, and deposit misuse create fragile systems. When scrutiny finally arrives, those systems unravel quickly. In finance, custody is trust. When trust fails, speed becomes collapse.